Right now, the US-Iran war has effectively paralyzed the Strait of Hormuz. This single bottleneck handles 20% of the world's oil, and the blockade has slowed that flow to a crawl. The impact at the pump was immediate. Oil is trading above $111 a barrel, and U.S. gas prices have already climbed to a national average of $4.18. Amidst this chaos, the United Arab Emirates just delivered a second shock. They are walking away from the OPEC cartel, ending a 60-year membership. This departure removes the primary institution that used to keep global oil prices predictable, introducing a level of market uncertainty that will ripple through every sector of the energy market. To understand the friction, you have to look at how OPEC functions. It is a cartel designed to artificially restrict the oil production of its members, keeping global supply low enough to support high prices. But the UAE has invested billions of dollars into massive refineries and drilling infrastructure, physical assets that are currently sitting idle because of those cartel rules. This chart shows the scale of the mismatch. The UAE has the capacity to pump 5 million barrels of oil every single day, but their OPEC quota traps them at just 3 million. That is 2 million barrels of potential revenue wasted every 24 hours. There is also a time limit. The UAE wants to monetize these reserves now, while demand is high, rather than waiting for the global green energy transition to turn their oil into a stranded asset. Then there is the rivalry with Saudi Arabia. As the de facto leader of OPEC, the Saudis have pushed for production cuts that the UAE increasingly views as a barrier to its own national growth. By walking out, the UAE is reclaiming its independence, stripping OPEC of 15% of its production capacity to secure its own financial future. Donald Trump has been a vocal critic of OPEC for years, repeatedly accusing the organization of inflating energy costs for the rest of the world. Washington sees the UAE's exit as a strategic victory. The U.S. is even considering a currency exchange lifeline to support Abu Dhabi as they break away from the Saudi-led group. This map of the Persian Gulf shows the U.S. blockade and Tehran's closure of the Strait of Hormuz, trapping a fifth of global seaborne oil. But the UAE's workaround utilizes overland pipelines, pumping crude directly to Fujairah port to bypass the blockades entirely. This isn't just about ignoring OPEC's rules. The UAE is physically restructuring how oil moves out of the Middle East to bulletproof their exports against regional wars. In the short term, this situation is highly inflationary. The UAE might be free to pump more, but that oil is still largely bottlenecked by the conflict in the strait. The institutional warnings are mounting. The World Bank is projecting a 25% jump in energy prices, and airlines are already cutting flights due to the soaring cost of jet fuel. Wall Street is preparing for the worst. Analysts at Citi have warned that Brent crude could spike as high as $150 a barrel before the year is out. This creates a period of extreme market instability, where the loss of cartel coordination makes it much harder to calm the supply shock. Until those naval blockades are lifted, the fracturing of OPEC actually deepens the crisis for the average consumer at the pump. But look past the immediate crisis, and a different reality emerges. A structurally weaker OPEC means Saudi Arabia can no longer exert tight control over the global supply. When the Strait of Hormuz eventually reopens, the UAE will be free to pump at maximum capacity, flooding the market with millions of additional barrels. Capital Economics suggests this could trigger a brutal price war between producers, potentially crashing the price of oil down into the $50 range next year. It's a paradox. The same geopolitical break causing a $150 a barrel panic today is building the foundation for a massive supply glut tomorrow. The 60-year era of OPEC acting as a reliable price stabilizer is breaking down. As that central control vanishes, energy markets are losing their safety net, moving toward a future defined by much sharper and less predictable price swings.